The United States has struck Iran. Israel has bombed Iranian nuclear facilities. And Iran has retaliated with ballistic missile attacks across the Gulf region. This is not a hypothetical. This is the reality of 2026. And sitting thousands of kilometers away, India is watching this war with deep concern. India imports 85% of its oil from regions that this conflict directly threatens. 9 million Indians work in Gulf countries and send home nearly $40 billion every year. And India's most critical trade routes pass through the very waters that Iran controls. Today I will explain exactly what this war means for India, for the price of petrol at your local pump, and for the rupee in your pocket. Welcome. Today we do a structured data-driven analysis of the 2026 US-Israel-Iran conflict and its cascading impact on India's economy. We will cover what actually happened and why. We will examine India's oil dependency and why it makes India so exposed. We will look at what is happening to oil prices and what they mean for ordinary Indians. We will analyze the rupee under pressure. We will look at the Strait of Hormuz, which is India's biggest nightmare scenario. And we will look at what India's government is doing about all of this. Let us begin. Let us start with what actually happened. The 2026 conflict has been building for years. The core issue has always been Iran's nuclear program. Iran had been enriching uranium to levels that both Israel and the United States considered an existential threat. Multiple rounds of diplomatic negotiations failed. Iran continued enriching. And then in early 2026, the calculation changed. Intelligence indicated Iran was weeks away from enough material for a nuclear weapon. Israel and the United States acted together. Coordinated airstrikes targeted Iran's main nuclear enrichment facilities at Natanz, Fordow, and Isfahan. Iran's response was swift and severe. Tehran launched over 200 ballistic missiles at American military bases in Qatar, Bahrain, and the United Arab Emirates. Simultaneously, the Houthis in Yemen resumed attacks on commercial shipping in the Red Sea. Hezbollah fired rockets into northern Israel. Iraq-based militias targeted American installations. The conflict has now spread across multiple theaters. It is not contained, and the direction it takes from here will determine how severely India is impacted. Now let us understand precisely why India is so exposed to this conflict. India is the world's third largest consumer of crude oil after the United States and China. Every single day, India needs roughly 5 million barrels of crude oil to keep its economy running. India can produce only about 600,000 to 700,000 barrels domestically per day. The rest, nearly 85%, must be imported. This is a structural dependency that cannot be changed quickly. The Gulf region comprising Iraq, Saudi Arabia, UAE, and Kuwait has historically been India's primary source, accounting for 55 to 60% of total imports. In recent years, India has diversified by buying large volumes of discounted Russian crude following the Ukraine war. By 2025, Russia became India's single largest crude supplier at nearly 40% of imports. But even with this diversification, India still imports 40 to 50% of its oil from the Gulf. That is precisely the region that is now at war. India's total crude oil import bill last year was approximately $108 billion. That is India's single largest import item. When this conflict pushes up oil prices, that number rises very quickly. Here is the direct financial impact in concrete numbers. Before the conflict escalated, Brent crude oil was trading around $78 per barrel. Today it has spiked above $95 per barrel. Analysts at major investment banks have published projections of $110 to $120 per barrel if the conflict continues at its current intensity. What does each $10 increase in crude oil mean for India? At India's import volume of 4.7 million barrels per day, a $10 increase adds approximately $47 million to India's daily import bill. Over a full year, that is $17 billion in additional expenditure. India spent roughly $108 billion on crude last year. If crude averages $100 per barrel for this financial year, that bill jumps to $135 to $140 billion. That is 27 to 32 billion extra dollars leaving India every year just for oil. This creates enormous pressure on India's current account deficit and forces the Reserve Bank of India to sell foreign exchange reserves to support the rupee. There is no painless way out of this situation. The Indian rupee is the next major casualty. The rupee and crude oil prices have an almost mechanical inverse relationship. When crude goes up, the rupee comes under pressure, and here is exactly why. First, India needs more dollars to pay for costlier oil. When demand for dollars rises, the rupee weakens. Second, higher oil prices cause inflation, which makes Indian assets less attractive to foreign investors. When foreign investors sell Indian stocks and bonds and convert rupees to dollars, the rupee weakens further. Third, when global geopolitical uncertainty spikes, international investors move money from emerging markets like India into safe havens like US Treasury bonds and gold. This capital flight also weakens the rupee. The rupee was already trading above 87 per dollar in early 2026. Analysts now project it could weaken to 89 to 91 per dollar under sustained high oil prices. A weaker rupee means imported goods become more expensive. Your smartphone, laptop, medicines, and every product made from imported inputs all get costlier. A weaker rupee is effectively a hidden tax on every Indian consumer. Now let me explain the scenario that worries India's policymakers most. The Strait of Hormuz. The Strait of Hormuz is a narrow body of water between Iran and Oman. At its narrowest it is only about 33 kilometers wide. But through this tiny channel flows approximately 20 to 21 million barrels of crude oil every single day. That is roughly 20% of the entire world's oil supply. And nearly 30% of globally traded liquefied natural gas also passes through this strait every day. Iran controls the northern shore of the Strait of Hormuz. Iran has repeatedly and explicitly threatened to close it if attacked. Now Iran has been attacked. The threat of strait closure is more real than at any point in recent history. If the Strait of Hormuz is closed even for a few weeks, global oil prices could spike to $150, $175, or even $200 per barrel. For India this would be catastrophic. India's strategic petroleum reserves amount to approximately 5 million metric tons, enough for only 9 to 10 days of national consumption. The International Energy Agency recommends 90 days of reserves. India has 10. That gap is a genuine national vulnerability that this crisis has put in sharp focus. Let us now look at how India is responding. India's approach has been classically strategic and consistent with its doctrine of strategic autonomy. Prime Minister Modi has personally spoken with the leaders of the United States, Israel, Iran, Saudi Arabia, and the UAE, calling for restraint and dialogue while carefully not taking sides. India abstained on UN resolutions related to the conflict, maintaining its characteristic non-aligned position. This careful neutrality serves a clear purpose. India needs to maintain oil access from Gulf countries, protect its 9 million citizens working in the Gulf, and keep diplomatic lines open on all sides. On the economic front, the Reserve Bank of India is intervening in the foreign exchange market, selling dollars to prevent the rupee from falling too sharply. The government is monitoring retail fuel prices and working with Indian oil marketing companies on supply management. India is rapidly processing approvals for new Russian crude contracts to ensure supply continuity. And in the longer term, India's push for renewable energy has gained fresh urgency precisely because this crisis has shown how vulnerable India remains to external oil price shocks. Let me now give you the key takeaways. The 2026 US-Israel-Iran conflict poses serious but manageable risks to India's economy. The three most critical risks are, first, elevated oil prices will increase India's import bill by $25 to $30 billion annually. Second, the rupee will weaken further, potentially to 89 to 91 per dollar. And third, the tail risk of Strait of Hormuz closure could push crude to $150 to $200 per barrel and severely damage India's economy. India's response, diplomatic balance combined with supply diversification and forex market intervention, is measured and appropriate. But the fundamental vulnerabilities remain: 85% oil import dependency and only 9 to 10 days of strategic reserves. For competitive examination aspirants, this topic is directly relevant to India's foreign policy, energy security, and economic challenges in general studies. The key data points to remember are: 85% of India's oil is imported, the Gulf accounts for 40 to 50%, every $10 oil price rise costs India $17 billion more annually, India has only 9 to 10 days of strategic reserves, and the rupee faces pressure toward 89 to 91 per dollar. If you found this analysis helpful, please like this video and share it with others who would benefit. Subscribe for daily current affairs. Thank you for watching.